it to X as well.
No worries. Don't worry about it. Big deal.
Okay.
Yeah, it's okay.
For some reason, it was also streaming to my Twitch. Okay, I'm streaming this on Twitch now too. Cool.
Yeah.
All right, great. So let's get started. So we're going to talk about the XC. So I'm going to share my screen. And just close that. Okay. So tell me how you became aware of this stock, Jack.
Well, I can't really say because let's just say that people had mentioned that this company was of interest for a bizarre reason, something to do with entertainment, the fact that it has entertainment aspect to it. And I looked into it a little bit, and I actually looked into the team that manages it, and their resume was extremely interesting. And so I was like, okay, so this is a very bizarre company because they have their hands in a lot of different industries, entertainment. And it seems like it doesn't seem like they have a real niche that they're really good at, but they seem to have their hands in a lot of pies. So
gotcha.
Yeah.
All right, I think that's better. It's yeah, it should be more of the actual screen that you see here. So you'll see I've got bunch of tabs here that kind of is usually how I organize my tabs when I'm researching a stock. So let's take a look here. So this is Seeking Alpha. This is the research platform where I publish my articles. So if we were to look at my profile, you know, you can see me here. I've written 250 so far. And so if I write one about DXC, which I might as well, it'll go in this list here. And, you know, you can look here and search tickers I've covered before. So, and it even shows how many times I've covered them. So some of them you can see I've covered more than once. Bitfarms I've covered 4 times. Look at that. So yeah, let's look at DXC then. Now, basically the point here is, right, to show you if I'm going to research a security, how I start. And for stocks in particular, because obviously with ETFs and other funds wouldn't be quite the same, I look at stuff like this. I don't look at the stock price, but this is the first page I reach. I go to the financials. This aggregates the financial data from their SEC reports, so their annual and quarterly reports. So if I want to switch to quarterly view, I could do that. It would show it here. It'll go back a few years. Usually I look at the annual data. And I have certain data that I like to get. For a non-financial like DXC, that typically entails the revenue, the operating cash flows, CapEx, and then money spent on M&A. And, you know, CapEx is really additions to property, plant, and equipment, or the net additions. Sometimes companies sell their property, plant, and equipment, and they raise some more cash, and then they roll that into new things. It's called a capital expense because it is capitalized on the balance sheet. So an operating expense for reporting purposes, if we go to the income statement here, an operating expense is like it'd be cost of revenues, and then it would be other things like general selling and general administrative expenses. So, you know, your overhead and such, maybe other things here. If you have any debt, interest you pay is an operating expense. So basically, it's an expense that you subtract from your revenues, and it's how you determine what your actual earnings were. And whatever this net number is, so if we look here, it says the net income to common shareholders excluding extra items. That's if there's any to exclude. Sometimes there are. This basically shows how much the assets on the balance sheet should change, right? So in 2015, the assets on the balance sheet should have declined by $222 million if they had a loss, right? They're basically saying this is how much our balance sheet shrank because of that, because of the income. And then if we look at for the fiscal year ended March 2024, they reported net income of $91 million. So the balance sheet should have increased by $91 million, right? Now, there are, of course, some things that can increase the balance sheet that aren't part of income, and this is a capital expense. So basically, if you look here, there's a few hundred million that they spend each year. And this is basically, we're buying an asset and putting it on our balance sheet. And it's called a capital expense because it becomes a new asset on the balance sheet. It is part of their capital base now. It is capitalized. And it does not count against, it's not considered an operating expense. Now, later on, it can be because there's a thing called depreciation and amortization. And this is basically taking previous capital expenses and subtracting them from earnings for tax purposes. Essentially, that's what that is. Okay. So that's all you really need to know. But I like to look at the cash flow because things like depreciation can concern old CapEx. It's a non-cash item. And I always like to know what is the actual cash flow situation. And so to know that, you get the cash flow from operations and you get the capital expenditures. And to a point, you might also look at their M&A, so their acquisitions. And so I need to, I guess, get the divestitures in here as well. But let's go ahead and look at what I got. So what's interesting about this business, right? You can, even though I don't really know much about what they do, I can kind of tell some interesting things. So we see here revenue was about 8.1 billion in the fiscal year ended 2014. Looks like their fiscal years ended in March, not on the end of the calendar year. So I actually think I need to update this. Is this because it starts with 2015? Let me just update this. And they should have fiscal 2025 coming out pretty soon. But anyway, you'll see it went up here, it shot up, and then it's been slowly declining. You don't often see companies with revenue trends like this. So this is definitely not a grower. Even if we look at it in terms of cash flow, I'm going to remove the adjusted figure for now until I get it fully. If we ignore what's going on with M&A, whether they buy a new company or they divest it, we see that there's not growth on the cash flow side either. It was growing in 2018, but it's steadily been going down along with revenue. It looks like it was lower in fiscal 2021 because you got to remember that's mostly calendar 2020 and what happened in calendar 2020, COVID. So they probably had a spike in expenses of some kind. If we look at their capital allocation between dividends and buybacks, in fiscal 2019, they spent a lot of cash on buybacks. The dividend disappeared in fiscal 2021 again. That's mostly 2020. So looks like COVID impacted the dividend and it hasn't come back. Now, but even when there was a dividend, most of their extra cash was used on buybacks instead of dividends. So instead of paying a cut of the earnings to all the shareholders, they were buying back shares on the open market. And this can be good for long-term shareholders, as a substitute for dividend, because if you hold on to your shares while others are being bought back, when the company itself buys back the shares, they take them out of circulation. So it's like a way to grow your stake in the business, if that makes sense. So that's what's nice about it. And it really just sort of depends on, are they buying back the shares at a good price? If we look here, right, it's look at how much most of their free cash flow. This is basically the cash they would have available to use for a dividend or a buyback on each year. If we look at this, most of it is put toward buybacks. So, here in 2015, right, they if you do the dividend plus the buyback, this is almost all of 2015's free cash flow. It looks like when they got all this cash in 2018, they did not get rid of it all right away. But in the next year, yeah, they used that to buy a lot back, and then in 2020 they bought a lot back. This might have actually been good because it's a good chance they used this in March. There's a possibility they did this in March of 2020, and therefore got to report it as such. So hopefully that's what happened here. Anyway, let's look at the. This is when I see a lot of buybacks like this, Jack. This is where I might actually start to look at the stock price history. So for right now, I've sort of summarized what I've seen in the financials. Oh, I guess one more thing is how the shares outstanding changed. Normally when this happens, some kind of merger occurred, and the details of the merger is that the old company got shares of the acquiring company as part of the deal. That's why that would be my guess as to why the shares almost doubled in size. I don't know yet, but if we're talking about analysis, thoughts that are coming to mind, I've sort of gone over a few things that I'm already starting to figure out, or at least it's the first hypothesis I want to test before I've actually read anything about the qualitative history. Just looking at the numbers so far. Is this all making sense so far, Jack?
Yes, it is. And
Right.
so something stood out to you as far as the trend is kind of odd. So you're saying it's not really a growing company. Would you, based on what you see, would there be any reason for you to want to go and do more research about, like, what are they exactly doing in the market? What do they have their hands involved in, trade publications? Would you be interested based on what you're seeing here, or would you say that it's kind of like nothing really exciting as far as any opportunity that you would see based on what
Yeah.
you've seen so far?
I'd be interested to know what happened here. Like you can see my cursor, I'm sure, all right on the screen. Can you see my
Yes.
cursor?
Yeah.
Okay. So
Yeah.
what happened here? I would want to know what happened here. Why did revenue shoot up? And then what's been causing it to slowly trickle down? Because it's still ahead of where it was a decade ago. Yeah. But I mean, it's just, it's like a very easy staircase down in revenues, right? And the free cash flow is mostly the same, again, except for the year of COVID for understandable reasons. I mean, we can go ahead and just look in the cash flow statement about what would have caused that, and trying to see what the most immediate expense would have been. Not really seeing one that jumps out in terms of a much larger expense year over year. They did have some increase in overhead here. Not sure what it was, but it did go up a bit. This went up a bit as well, and then it went down sharply. Again, I don't know what caused that. So it's not immediately clear from the expenses. I could look at the cash flow statement. And let's see, cash from operations was definitely lower. Okay, so apparently the year ending 2020, they had this asset write down and restructuring costs that was just paper. So they actually had a much higher 2020. Interesting. They had lost from the sale of an asset. Okay. Or a gain from sale of an asset, but not part of their operating cash flows. Okay, so interesting things going on here. We also see that in fiscal 2021, they had a divestiture. So they spun off a business. Very possible they spun off part of their business in response to COVID in order to raise some cash. Let's take a look at what their long-term debt has been. Again, not even really the story yet, but I'm just sort of looking like where the numbers go because I want to know what the financial trends have been, and then I know why the story would be important. So, yeah, the same year that they shot up, if we go back here, boom, same year revenue shoot up, they take on a lot of debt. So it leads me to believe there was some sort of leveraged buyout that happened, and then they've been slowly paying down the debt. They took on a lot more debt in the year ending March 2020, and again, the pandemic would have taken off in literally in that March. So probably by the end of this period, because usually it's like the 31st of March. Even if they don't end their fiscal year on the hard calendar date, they usually end it on the hard quarter date. So like the 30th or 31st of that month. So they probably would have realized, oh, we need to raise a bunch of cash, and sold a lot of debt. Looks like they managed to get a lot of it paid down. So yeah, that's they have been getting their debt down, so that's a good thing. Even getting, I mean, they almost doubled it because of COVID, it seems. So that was pretty good of them. So that's a good thing. The decline of revenue thing is a concern. So to go to your other question, I don't think that the I don't think it probably has a terrible balance sheet right now. If it has maybe $3.5 billion in debt and it can generate over $1 billion in cash each year, it's probably very easy for them to repay that debt, or at least be able to refinance it if they can't pay it all off when it's due. I would need to look at the maturities of it. But long term, there aren't very many stocks you'll want to buy where the company is clearly shrinking. So I would need to look at what the year-to-date data is for fiscal 2025, because there's been a few quarters of that now. But my guess is that it's not growing much. And borrowing from the ideas of someone like Warren Buffett, we call this style of investing value investing. And a big part of value, like what the business is worth, because this is what I told you in our first stream, right? About, like, look at a hot dog stand, how much money does it make? If you know that, you know what you want to pay for it. A big part of how you value a company is its growth prospects. It doesn't have any. If it doesn't have growth prospects, you at least want to be able to trust that it can maintain what it does. And if it's not maintaining, if it's clearly shrinking, you have to ask yourself, well, what do I like about this? So let's take a look at the price history here. So over the last decade, price was near 100, and now it's down 90%. So already, let's take a look, right? It looks like the buybacks were happening at the peak of the price. I mean, look at where it was here, right? This is in 2018, and 2018 would have been fiscal 2019. It's not great when the company seems to be buying back its shares at the peak of the price. I mean, it was probably staggered throughout like this period here, but this is way higher than this. And that obviously, they can't predict where their stock will be, but it does suggest that the money could have been better used, such that because it looks like they had sharp drops. So it seems like they were just consistently like having bad news. Like, look at these sharp declines. Usually it's like they come out with results. So maybe they come out with full year or fiscal year 2018 results here, because you usually come out with it like a month or two after. Come out here, it was bad, down. And then we go down here, another quarter of results comes out, that was bad, down, right? And that's usually what that means when you see something like this. I guess if something similar happened here, something really bad news, boom, just in like a week, it's less than half. And even during the bull market of 2021, it was not able to get back to where it was here, and it's been steadily declining. So there's a lot of warning signs, and I don't even know what the business does yet, really, other than that they do IT. So Jack, you're familiar with the company somewhat. Do you have any inklings so far about what the causes of these things might have been? Oh, I see you were you had fallen out for a moment, Jack, so I just added you back. Were you able to keep up with some of the stuff I was saying?
Yeah. And so just repeat the last thing that you said, because you cut out right there at the end. So
okay, yeah. I was saying, so I've said a lot of things that I've noticed, and I kind of know what some of the warning signs are, but I don't even really, even though I don't know what the company actually does yet, other than IT. So my question to you was, do you have any at least inklings about what is going on with the company that might have caused these sharp drops, because these are usually not like trading things. These are usually the market, like long-term investors, ownership, people who buy stock with an ownership mindset, like I've said. These are usually those people changing their minds drastically, like, oh, this is not at all capable of making as much money, I need to get out now. And it's just right, that's usually what happens when you see a sharp, almost completely vertical drop like that.
Right. So I'm not sure. So let me tell you some of the things it has its hands in. This is what they highlight as their main things. Okay. So harnessing AI to revolutionize healthcare. They're basically like, trying to integrate between monitoring systems and collate that data for, via AI to like automate the jobs of nurses and stuff like that, essentially. You got AI agents for the public sector. So basically they're trying to model like decision-making processes for governments, essentially. They're doing AI for the vehicle. They're saying basically like they're trying to direct data from automobiles and drivers and send that to the infrastructure of the local municipalities, essentially. So they're basically like saying like, where choke points for traffic and stuff like that.
Okay.
So they're trying to basically automate the pharmaceutical approval with general AI. They're using it for basically they're trying to use AI to embed sustainability decisions into automakers' businesses.
Okay.
And digital banking. And so basically they're doing like, and I'll just give you a brief overview. They do aerospace and defense, automotive, banking, consumer retail, energy, utilities, oil and gas, healthcare, insurance, manufacturing, public sector, tech and telecoms, travel and transportation. So they literally have like 10 major, industries that they're supposedly involved in. So
Okay.
Yeah. For IT. Yeah.
So I'm gonna, again, this is part of the analysis. These are the natural things that come to mind. You said a lot of stuff about AI, but there would have been no talk about AI here for like 80% of this chart. No one's talking about AI for this company, right? So I have noticed that a lot of companies will say, you're an AI something or other company. And they just write that in their financial reports. Like, what kind of company are you? We're an AI something or other. We do this with AI. We're AI powered this or whatever. And 2 or 3 years ago, they wouldn't have even come close to saying that, right? So some of that, I assume you're going off of what they say about themselves. Some of that could just be framing, and there may not be any substance to it. So that's just the thing. We want to, when you're an analyst, right, you got to smell for bullshit a bit. That's a big thing of bullshit where it's arguably true, but it's not outright lying or fraud, right? Whereas NVIDIA can claim to be relevant in AI because they are making the chip that everybody uses for it, right? The whole reason there's an AI renaissance, or no more, not even renaissance, more like it's a Cambrian explosion of AI, is because of them. Their hardware makes it possible. So they get to say that because they open the portal to that dimension, basically.
Right.
But, basically, there's a thing companies do where, maybe they'll subscribe to a data center service that allows them to use AI, and they run their software through it. And they're like, we're an AI company, right? But not everyone gets to say that. And I'm just going to notice this, right? When did generative AI really just start taking over the imagination? Like, there was a moment when basically nobody was talking about it, and then overnight everyone's talking about it, and they haven't shut up about it since. Do you remember roughly when that occurred?
You mean when the AI thing happened?
the generative AI craze happened, right? Even if we could talk about when the technology was already around, when did everyone start talking about it?
I would say like the end of 2023.
Okay, sometime in the second half of 2023, we'll say, right?
Yeah.
Okay, so here's where they are. I remember it being about late summer, right? So here we are, we're in the summer, and they go from about 28 to under 20. They have one of those shot charts. Let's go to the 5-year view. It'll be easier to see, right? Here it is. Boom. So AI is starting to take the waves, and for some reason it goes down. Once again, I mean, this is like a 30% decline, right? They're hearing something they don't want to hear. And here, AI is really big in the waves. They are not taking off, right? I mean, maybe it started to get out now. By the fall of 2023, right? People were really, really talking about it. I remember this. Okay. A lot of stocks are taking off at this point. But if they didn't take off here, they're taking off here, not DXC. And if we look, a lot of stocks would be like continuing to go up if they're really writing AI in some meaningful way. This isn't, right? Now, momentum traders can always do their thing. They don't have to care about the fundamentals of the business, right? They can basically, it's like, for them, it could be rock, paper, scissors, right? They're just reading when the other people are going to get in and out of a position, and they're one step ahead. But for the most part, this suggests that people are not confident about the earnings ability of this company. So we'll want to examine what exactly it is that they do, and if they're actually in a position to benefit from AI.
So how would you probably try to figure that out?
Well, we can start just by looking at their business description on their 10K and see what they say. So the DXC and Nevada Corporation is a global IT services market leader. We provide mission-critical IT services that transform global businesses. We deliver excellence for our customers and colleagues around the world. Now, I will say, a lot of companies, if they were going to bullshit about being AI, would say AI somewhere in their first sentence. I have seen that. And so, like, I can look at the 2024 10K or the 2023 10K and see we're an AI company of some kind in the thing. And if you look at their 2022 10K, no mention of AI. You control F, artificial intelligence, AI, you do not find it anywhere in there.
Right.
So I will say they're at least not in this. They're not framing themselves as an AI company, even though, in this report would have come out in April or May of last year. It would have been plenty of reason for them to start saying we're an AI company.
Right.
So they have about 130,000 people in 65 countries. They represent close to half of today's Fortune 500 companies. So they have two segments: global business services and global infrastructure services, to provide solutions that modernize operations, drive innovation across our customer's entire IT estate. So it sounds to me like they're saying this is probably where the government programs is. They're probably doing infrastructure.
Right.
For infrastructure is probably like, I would think, departments in local or even national governments. And this is for their commercial partners. So, like, my guess is that any big company that's not tech and has its own IP.
Right.
So that would be my guess. If it's about half Fortune 500 companies, that's a good thing. So let's see. Global business services. So a portfolio of analytic services, extensive partner ecosystem helps customers gain rapid insights, automate operations, and accelerate their transformation journeys. We provide software engineering, consulting, and data analytics solutions that enable businesses to run and manage their mission-critical functions, transform their operations, and develop ways of doing that business. Okay, that sounds like IT, right?
Right. IT solutions company, essentially.
Yeah. So it sounds like that. Here's the thing. I think AI probably will make IT better.
Right. Definitely.
So
I talked to people in IT, and they all say that, like, basically they're training their replacements that are either some hybrid of like people from Indonesia or Malaysia, and or they're training their AIs to do like most of their job, but then it's like getting harder for the bosses to justify their salaries. So they're like, okay, well, we need.
This could be a good thing. Now that might be a good thing for the business, because that's a lot of overhead that just disappears. And then
Correct. Yeah.
if we go back to the financials, right? Let's take a look at their selling and general administrative expenses, right? So except for fiscal 2022, for some reason, it has never been below $1 billion. For some reason, their general administrative expenses weren't even $500 million. But it's never been lower than $1 billion, and rarely been lower than $1.5 billion. Sometimes it's even been over $2 billion. Now, some of these expenses can include stock-based compensation and things like that. We can actually look at their stock-based compensation. We go here. It gets well. If you look here, stock-based compensation is not a big part of their expense structure. So it's really not what it is, which is interesting to me.
Why is that interesting, in your opinion?
Well, it just means that there's a lot of their expenses seem to be actual cash items. Because stock-based compensation would usually be one of the main things that detract from it. So yeah, so that's interesting. So yeah, if they could get rid of a lot of their payroll, I mean, there's hundreds of millions, maybe even $1 billion on the table that are opened up to shareholders at that point, right? And
right,
if that alone, if we look at, well, let's go to this chart here, right? This is the cash they generate, right? So this isn't the earnings they would report to the business, but this is the net cash they generate when you cancel out the non-cash items and basically say, well, what is cash that would be available for dividends or buybacks to the shareholders?
right.
This is it. And, you're basically doubling the if we think of this as the true earnings of the company, you can basically double that if you get rid of the payroll. Maybe even increase it 50%, right? I mean, who wouldn't you want to own a business and then you hire a manager, and then the next year they say, hey, I made some changes and we got your payroll costs cut in half, and it's the same level of productivity. You would love to hear that, right?
Well, and then you could also say that you could leverage whatever you've done in that process to say, now we can put all this money that we have laying around towards asset acquisitions and mergers, and
that's also possible.
And also, like, we can basically just repeat what we've done, or basically bid on contracts that other people can't, because we've kind of got the edge on this particular niche. And again, what kind of fascinates me about this one is that even if they're not really good in every single sector that they're in, there are like 10 major sectors of the economy. So if they only hit one of those and get it right, that would be very interesting, right? See that, like, and again, I'm not, I'm just thinking, like, it's kind of shocking that it's not a bigger business if their hands are in all these different.
Okay, I see now more what their segments do. So the global business services is basically your more traditional idea of what the IT guy does. Like, these are the things that they would do. And then their infrastructure is actually the infrastructure of their IT service. So cybersecurity, and some cloud infrastructure, and then this seems to be more like some kind of consulting service they give for just how you can organize your workplace, going a bit beyond IT. Okay. So important divestitures. Okay, this would be good. Sale of its German financial services subsidiary to FNZ Group. Completed sale of its healthcare provider software service to the Dallas Holding. Okay. So it looks like it was divesting some maybe non-essential things. Seasonal trends. My guess is they have a lot of business accounts. Their seasonal trends are based on when companies get their budgets done, which usually it's aligning with uh, close to the end of the year. They're preparing next year's budget. That's a common thing. It's a competition. Highly competitive. Competitors include large multinational enterprises that offer some or all of the service solutions that we offer, smaller ones that offer focused solutions and solutions similar that we offer, offshore service providers in lower cost locations, particularly in India, that sell directly to end users. Solution or service providers that compete with us in a specific industry, segment, or service area, and in-house functions, or corporations that use their own resources rather than engaging an outside IT services provider. So I will say this is one thing that I think is considered. It's something that you kind of could already guess, but it's important that they spell it out, is that you might say IT is part of tech, right? If we it'd be more appropriate to put that in the tech sector than other things, but it's more the service around tech, right? Sort of like how it's not like they're not like Apple where they're making the iPhone. They're not like NVIDIA where they're making the GPU. They're not like or Palantir where they're making the data analytics platform.
Right.
They're just helpers that help with, like, at their most basic, they're the guys that just will say, hey, is it turned on? Do you have it plugged in? And they'll start there. And there's some other things they do that are more sophisticated than that, but it's that type of service. And I think we all know that that's often a very competitive environment, because like I mentioned before, the big tech companies probably have their own IT system. There's no reason for them to outsource IT. A lot of normal companies still have their own IT employees. They don't often outsource that. There are a lot of businesses that could probably do their, like here in the West, and do their own IT business just fine. And then, of course, like they mentioned, it's easy to outsource to other countries where labor costs are lower. And so it's not like, who's the, I gave you some important, names in tech, right? We know who the Apple of cell phones are, right? It's Apple. We know who the NVIDIA of semiconductors is. It's NVIDIA. We know who the Palantir of data analytics is. It's Palantir, right? Is DXC the DXC of IT? Well, I don't think there's any leading name in IT. I think
Right.
If you went around and you asked people, what's the most important? You went around and you asked managers, right? Who have to figure out what the IT situation is, who has to be familiar with it. Ask managers across the country, who's the big dog in IT, like Apple is in cell phones. I don't think they could tell you, right?
Right. And do you think that as the AI stuff kind of progresses, because it seems that it's going to progress relatively quickly from here forward as far as the computing and connectability of all these things, do you think that there probably will become a ultimate arbiter of this stuff, like whoever kind of basically says like this is the way the cloud is going to run from here on out, and maybe that'll be NVIDIA mixed with IBM or something, but still at some point, like, there's going to have to be some sort of major protocol to kind of like I would assume that there will be some sort of overlay protocol of like, this is the way we're going to do the cloud structure here on out. Like Google and AWS and all these different companies are kind of like they're trying to become the main cloud.
Basically what you're saying is I think if I could put it in a very short sentence, is this something that could easily disrupt IT, even really good IT, right? Like take really good IT, a really good IT company, even if they do everything correct, is it possible that just the sheer quickness of AI in its development and who really gets to decide where that goes could just smash it with a hammer? And it seems to me like what the essence of what your question is asking is like, is it possible that no matter what they do, this could just develop in a direction, and it's like a very fast developing thing. Like in a year, it could be the case that AI is developed to a point where a standard is set. This is how cloud is run. is how everything goes. And if you're not already here, you're out. And something's going to do your business better. It's already set up. We started preparing it less than a year ago. It's already ready to go. We came up on you that quickly because that's how fast AI is. Is this stuff possible? We're thinking about. And I think what's interesting as well is some of this seems to be from divestitures, but it clearly seems to be the case that DXC was not building up business. Because usually, I've seen businesses that will regularly divest some of their subsidiaries, and the revenue trend is still at least somewhat positive because their core business is still growing, right? They're taking the cash that they get from the divestiture, they're reinvesting it in their core business, and where they can just get a better return on capital, they have more operating efficiency. It's the tricky thing about M&A is you have to be able to make things that weren't made for each other fit in a new way. And if you can do that, you can create lots of savings sometimes. But if you can't, then sometimes you just waste a lot of money. And as I look through this as well, principal methods of competition markets include vision and strategic advisory ability, integrated solutions capabilities, performance and reliability, global and diverse talent, delivery excellence, ongoing support, responsiveness to customer needs, competitive pricing on services. It seems like there's a lot of things that are weighing them down. And I will say, compared to other 10Ks that I read, this seems to be pretty emphatic on what their competitive weaknesses are, which is good. They should do that. It would be a bad financial report if they weren't emphatic about here's what's keeping us down. Looking here, a lot of this stuff, like the human capital management, I don't find is typically too insightful about the business. The ESG stuff, there's really nothing useful here ever. Intellectual property, that might be useful for some businesses. I don't know that an IT company is going to be have a lot of important IP. Maybe if it were like Warner Brothers or something, right? Like something where the IP is pretty much everything they do, right? So I think let's take a quick look at. So this is their latest quarterly thing. So that was the issue here is that since this was for the year ended March 31st, 2024, a lot could have happened since then. So this is really just a snapshot of the business about a year ago because it's February 25th. So let's just take a look here. So there's this is for their latest. This would be their Q3 fiscal 2025. This is the investor relations page of their site, by the way. So I often will search the ticker, and then I'll type IR for investor relations, and it'll take me. That'll usually be the first result. So this came out on February 4th. So this and this are pretty current. This came out this month. So not really seeing anything about AI here either. Looks like it's mostly saying.
Oh, no, go ahead. I was just saying I see the key metrics down there, those little bullet points.
Yeah, down 5.7% compared to the prior year, 5.6% on an organic basis. Diluted earnings per share of 23 cents compared to 49 in the second quarter. Operating cash flow of $433 million, less capex of $340 million, resulting in free cash flow of $93 million, compared to free cash flow of $16 million in the same period a year ago. I think that kind of reflects the seasonality a bit as well. This does show where their business is concentrated. So there's a revenue. It's actually mostly European in its focus. The U.S. actually is not that important of a market here, which is interesting. So it looks like the European continent and the UK together are a bigger market than the U.S. And Australia is almost, it's when you think about the size of Australia compared to the size of the U.S., yeah, this isn't very much. And then if we look at, it looks like the U.S. market took a big hit. So they seem to be doing well in these other geographies, but yeah, it looks like something is already disrupting them in the U.S. would be my guess. This
Yeah,
is for the 6-month ending. Yeah, still, even if you compare the first 2 quarters, so that might be part of why. Because, like, let's face it, if you're going to have a strong position in a geographic market, which one would you not want to be losing business? The United States. Yeah. I mean, that's where your easy cash is going to be, right? Right. There's a war going on here in Europe, right? This is not where you want the business to be. But it's down in all their markets too. But it's just in the one where I think there's, if you can do well in the U.S., there are so many more revenue opportunities that open up, right? Like what you're
so
like these are their revenues currently, right? If they could be strong in the U.S., they could open the door to just new types of revenue that you can't even think of right now.
So if you had to think just on a logical basis, okay, so like what would you suspect is going on in the IT field right now that might be, because like I would think that IT services would be better than ever to be in that business, but is it the AI that's shaking that up as far as the competitiveness, if you had to guess?
Well,
Or no?
one thing we can do is we can look at the transcripts from the recent earnings call and see what the analyst said. So, and this presentation would have been prepared for the earnings call. So,
Right.
revenue growth down. Ooh, okay. CFO update. In here. So they have free cash flow here. They're showing. Oh, so they count some other things too. So payments for transition and transformation contract costs, software purchased and developed. All right, so they're doing more than property and equipment, it seems. That's good. So their free cash flows actually seems to be lower than, I need to revise some of this. It seems to be lower than the typical amount I would do. Because they're saying 756 here. If we go here, yeah, I had a little over $1 billion listed, so it's definitely important. Let me see where that's expressed on the
This thing almost $500 million. For
yeah.
What the hell? It's pretty weird.
Okay, here we go. Purchase of intangible assets. This is probably their investments in software here. Maybe it's their other investing activities. But yeah, these are other things that we might consider in the cash flow situation. So yeah, it's worth thinking about this as a lower free cash flow estimate. M&A isn't going on anymore, so we probably don't need to worry about that. But yeah, so that's interesting. So might be more reasonable to think of them as a business that makes about $700 million in cash each year. If you look at the market cap, it's $3.5 billion. So it's basically trading for like a 5-year multiple of its cash flows, which isn't surprising considering how it also seems to be shrinking. So transcripts and insights. Let's go back to the transcript. So we see here, reflecting on my first year as CEO. So this is a new CEO. My guess is it was realized that some sort of change was needed. Possible the other CEO just retired. But there's seems like usually with a new CEO, the idea is they're trying to change their strategy and they need someone else at the helm. Looking through here, connecting better with customers, pipeline continues to grow. Help clients leverage AI. So it seems to me, based on that, help clients leverage AI, that what's probably helpful, they're helpful is clients who are using AI in their operations, they're helping them do that. But it doesn't seem like the IT itself, based on this description, is holding any of the keys to AI, we'll say, right? It's more of a, like Morpheus saying, I can only show you the door. You're the one that has to walk through it. Well, how many times do you need the door shown to you, right? And so its examples include collaborating with SAP to incorporate their business AI solutions into industry framework to help clients accelerate their blah, 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 blah. So talking a lot about AI here. I mean, look at all the talk of AI, AI. Partnership with Ferrari. I mean, so there's Brad Novak has joined leadership as the CIO, bringing 30 years of experience in data architecture and technology strategy. So this probably means he has some experience in building out things like data centers, fiber networks, things like that. He probably, and making stuff like that work together. That's probably what his background is. Let's see what the CFO has to say. Okay, because they'll usually say it was down this much and this is why. Primarily driven by higher yields from cost management initiatives, is deferral of our certain planned marketing IT investments to ensure they are more closely aligned with our evolving business priorities. Not a whole lot of discussion. Okay, GBS. It's primarily driven by ongoing market pressures affecting custom application projects, which account for roughly 2/3 of CES revenue. However, this plan was partially offset by momentum in our enterprise applications business. We continue to increase our capabilities. Book-to-bill ratio improved in the quarter to 1.28 due to third quarter seasonality. Insurance and horizontal BPS organic grew. I'm assuming they mean GBS, and it's just not transliterating it well. But yeah, what I'm seeing here is if I look at the GBS declines, but what was it said about market pressures? Where was that? Okay, yeah. Custom application projects. Market pressures are not clear, but I assume they're probably referring to competition.
Custom application. I wonder what that means.
Yeah.
What is that? What do you think that means? Custom application is that?
My guess is that there are a lot of IT services have a very general framework, and
right.
Whatever your business is, you kind of just use the IT structure that they have. And there are some businesses that may be able to be more like water. They'll take the shape of whatever the container is, wherever you pour it, and so they might be having trouble with that. And
Yeah.
It's one of the things where like if you're better than second place, it's like a night and day difference kind of thing, right?
Right. Well, and it says right there, it says and resale revenue down 30%. That stands out to me too. Like, I wonder what that means. Right there in the middle.
Yeah, Modern Workplace declined 11 points. Services revenue down, resale revenue down about 30%. There might be a specific product for related to something called resales if we're talking about like a modern workplace.
So they're losing. So it seems like they're losing traction in, you know, their part in, like, you know, office settings, I guess, you know, like trying to.
Could be. So there's a lot of signs here that if there's any benefit from AI to increase their business, they are not occurring right as AI is being adopted and implemented.
So they're trying to scramble and catch up, it seems like.
Yeah. So it looks like they're already being disrupted. Like we're seeing it in real time, just looking at these comments here.
Right.
And this is the Q&A with the actual analysts. So these are the folks that represent like the banks or investment firms, and then they'll publish like what their price target is based on the information of the earnings. Let me look back at the slides again. And I'm going to say this is an interesting presentation. And I know why, because I have to look at a lot of these. There is almost nothing here talking about here's our projects, here's the progress on these projects, here's what our strategy is looking like. It is just a dry, here are the numbers. You almost never see that.
Yeah.
Slideshow.
So what would you say, like, and maybe you don't know, but what would you surmise might be going on that would be? Is that just because they're worried, or would that be because there's some other?
I think it's because they don't really have much to talk about.
Right.
I mean, I think that's what it is. I think when you have something to talk about, you put it in the slideshow. We've got this facility built up. We just completed this. We just acquired this company. We got all their IP and their technology, and this is how it fits into the model. We just developed this new product. We expanded this service, or just there's things to talk about. Or like, here's our 5-year strategy, right? Once we finish building this out, we'll be able to start doing this. That cost will go away. You know, profit should be about this much higher at that point. These are the investments we're making. There's like very little of that. Let's actually take a look at how the revenue breaks down. So, look at the total revenue. So, revenue for Q3 is about 1.6 billion. That's just in the GBS segment. Okay. Where does it? Whatever. So, almost 1.3 billion in the consulting and engineer part. So this, I think, is maybe the big part of what people think of as IT, insurance, software, BPS. Okay. This much, and most of it is cloud. Modern workplace is less. This sounds like it's less intrinsically IT, so I'm not surprised that it's quickly becoming useless. This one sounds like would be more helpful. All right, so there's one more thing we can do. We can look at the debt. And I will say, it's kind of really hard to get a figure of what they do if they're so it seems like they're nervous to talk about what exactly it is they're doing. Is there, let me see if I can find maybe charity somewhere. Trying to find, where do they usually have a table saying when their debt is due. Here we go. Let's see. So of their $3.5 billion in debt, looks like most of this is due on the right 10Q, right? Hold on, did I click the right one? me make sure I did. Whoops. Okay. So go to SEC filings. This is the latest 10Q, right? Whoops. Maybe I clicked the wrong one. Oh, I did. Thought something seemed off about this. Okay, down 5.1. I think I was looking at 2024's. I think I had the wrong gear clicked on their investor relations page. I knew something seemed off about this. This is why it helps to check the tables and make sure you're looking at the right dates. Well, okay, so this is different here, but look, I mean, it's even smaller, right? Look at how much the U.S. market has continued to decline. So, I mean, it's just even worse news there. Geez. Okay.
That's kind of fun, but yeah.
All right, let's see. Where is the debt? I just want to see what their debt maturities are like. Are we seriously? Maybe I need to search the word maturity. Okay. There we go. All right, so most of this is due within this 2025. Yeah, most of this is due within 5 years. It's staggered, so that's good. I mean, look at the principal due each year, right? This is basically all their free cash flow. So they either have to refinance it or pay it all off. If they refinance now, they're probably going to get higher interest because look at this. This is low. How many? I don't know when these would have. These are senior notes, so these are bonds they sold on the market. I don't know, when these would have been issued, but I don't think they could get less than 2% interest on bonds that they would be issuing today if they're going to refinance.
Right.
Because you can get about 4% or more on like a treasury 1-year note. You can probably get similar yields on European bonds. So the question is, why would you get one of these bonds at this interest rate? So my guess is that their interest expense will increase a lot, or they're just going to pay it all off with their cash. But I think, for a company that can make about $700 million in cash each year, I mean, we're seeing a lot of the reasons why it's $3.5 billion for. Let me see if I need to refresh this. What is there an updated closing price? No, okay, $3.5 billion for a $700 million free cash flow company. It's in decline. Probably gonna have to pay a lot of its cash over the next 5 years in repaying the debt. Maybe they'll refinance like half of it and pay off the other half of the principal and slowly decrease their debt balance. So if we look here, if we can kind of look at what the trend has been, right? It's where's the long-term debt line? Yeah, if we look at what the trend has been, right? Especially if we start from when they, let's start with here, right? As soon as they could, they got the COVID debt down from like 8 billion to about 4 billion. So cut in half, and they slowly just been chipping away at it. So my guess is that they'll continue to chip away at it. I don't know what the other maturities were like, but if they can get low interest, maybe they can still do it. But I would just say, the bonds that will be coming due soon, they probably got these bonds like around here. That's probably when they issued them.
Right.
Interest rates were near zero around here, or they weren't really higher than 2%. So they're probably going to be doing like 5 or 6% interest rate bonds here if they have good credit quality. In fact, I think the 10Q was showing their credit ratings are as follows. Those are not good credit ratings. Okay. negative. Okay, this is. I think this is technically considered investment grade on Fitch, but yeah, this is not good. But they would need to be like, double A or triple A to get low interest, right? Is basically
Right,
what I'm saying.
right.
This is not. This is if things go well, they'll get like 5% interest maybe. I don't think that's likely. So 6% I think is optimistic for them. And it's just maybe they don't want to refinance at that. Maybe because at that level, right, that's actually going to be quite a bit more, just several million in interest expense each year. Maybe they're just better off paying it off, especially if they're a shrinking business. Debt makes more sense when you're a growing company. It doesn't make sense when you're a shrinking company.
Right.
Yeah. So basically, let's think about the analysis, because we've been doing this for about an hour now. There's a lot more about the way the company works that we could maybe try to figure out. But I mean, again, let's notice the slideshow. They don't seem to be eager to talk about themselves.
Right.
That's very telling. I don't usually see a slideshow like that. Usually, it's just even the ones who have bad news have something to say. But I've noticed that when the cards are very close to their chest, that's when it's just like they're like, "Yeah, we're here," and it almost feels like reading. It kind of feels a bit like reading about one of those like brick and mortar sporting goods stores.
Right.
That you might remember, those were like really popular 20 years
Oh
ago.
yeah. Yep.
And they are just withering away.
I used to work right next to a major, giant, popular one in Northern California, and I watched it the last 2 years as it shut down, and it was just like so sad. Like,
Jack, your mic is very staticky. Yeah. Oh, I saw some people in comments just now. Interesting. Yeah. So welcome, folks. Even though I'm like half an hour late. It looks like they came in through your stream though, not mine. Most of them.
how's it sound? How do I sound now? Okay.
Still very.
Oh, let me refresh the page. I'll be right back.
Okay. Okay, welcome back, Jack.
Yeah, thank you.
That's way better. Way better.
Okay, good. So I think what I would say is I forgot what I was saying actually. So I forgot what
about like just
yeah.
a bad outlook for the business.
Yeah,
and
I
something
watched-
about a sporting goods company. Yeah.
I watched a sporting goods company go out of business as the online retail basically set up. And there's still some okay sporting goods stores, but they're really falling behind because most people are just going to order online anyways, right?
Mhm.
So
That's it. That's exactly what happened. COVID permanently destroyed a lot of brick and mortar retail business. And there are some things that's interesting. Some things were just COVID stocks. They had a lot of business while COVID was happening, and then when people went back to going outside again and not social distancing, their business went away. But some things, people realized, hey, this is just better. We should never go back to the way things were pre-COVID.
right.
This is Big Five Sporting Goods, right? So let's just look at them.
And I
Look
think
at this. Look at this. This
What
is the bull market here, but like let's just look at like a more normal thing, right? The 23. Let's look at the 10-year, right? So even they're a penny stock now, and I actually was the last one to cover them almost a year ago to the date on Seeking Alpha. Their market cap is $31 million, And I said they were a sell. You will not find me writing sells anymore. But oh boy, the sells that I did write when I wrote them, they weren't always as obviously correct as this one. But yeah, this one has been withering away. So I'm just going to say, if it's a company that's in technology in some way and it's a declining business, it doesn't really seem to be benefiting from AI. That's all concerning. So they're mostly buying back shares now. If we look at, let's take a look at, somebody do this quarterly. Let's take a look at the, this is, I'm basically going to look at what is the positive case for owning this stock. Let's see, they are, okay, on a quarterly basis. So they went from, but sometimes their shares outstanding go up. Why is that? Is people exercising stock options? Let's take a look at the cash flow. No, it might just be because of their stock-based compensation. There's a little bit of that still. Okay, whatever. The only thing that might make the shares a good investment is if they're being bought back, because you see if the share count goes down, that means the shares are being bought back. And between most quarters, they go down. And so they are declining. If we look at from about 230 to 181, let's do this. So let's see. So 230, 181. That's a 27% gain in your position in the company. So your stake in the company is quickly growing. Like this is from middle of 2022 to today. So in 2.5 years or so, almost 3, your position in the company is 27% larger. So the question is, maybe if the buybacks are good enough, you can grow your stake in the company through the buybacks faster than the free cash flow declines. That can work. It's not great, right? Because you have to assume it's going to continue to be a gradual decline in cash flow. And it seems like this business is in the middle of disruption. And there seems to be a general idea that the only reason generative AI has not taken off faster is because we're getting the infrastructure to run it built. And once that's a lot of that is finally online, the computing capability is going to just shoot through the roof. Right? It's one thing to develop it, and we had a very limited amount of hardware to run the AI because we didn't know we were going to need it, right? But we're almost 2 full years into the capital projects to build out these data centers, right? Like we're not far away from it just taking off. What happens to a business like this? Does it continue to be a slow withering death where your stake in the business grows faster than the decline happens? That might be fine because, again, if that can happen, the company might be, let's say in 5 years, it might be earning 25% less cash, but your position in it might be 3 or 4 times larger, right? That's technically a gain for the individual share. And you could be paying, maybe because they start paying good dividends at that point. Or maybe they get bought out just so the acquirer can get their customer accounts. Maybe that happens, right? Get their contracts, right? Maybe you'll get a good price then too for that. Sometimes they'll pay a bit of a premium just to go ahead and get the contracts and simplify it. Those are things you can do, but they're not really things you want to bet on, right? When I said growth is part of value, let's just take a look here, right? This is a retailer. This is someone that you could say has some vulnerability to e-commerce and tech, but Costco, right? Let's look at the revenue, right? it is growing. And I mean, look what happened in COVID, right? It grew. It has never had a smaller year throughout this period. So, yeah, it seems to me like if you wanted to, you know, even if you could get one that's just not a tech company, you know, you have growth here. Now, I would question the price because it doesn't make sense to me that, you know, from let's say here, yeah, like around here, it's doubled, right? So from what, early 2022, it's crazy to me that even though sales did not double, not even sales, the price of the company doubled, right? If we look at the cash flow, right, the cash flow doubled. No, it's maybe 50% higher for these years specifically, and that's just the operating cash flows. It does not look like it's consistently it's not like twice as large of a company in its fundamentals. It does have some fluctuations because as a retailer with tight margins, if cost of goods are low one year, they'll have significantly higher free cash flow. So some of it is Costco's margins are so thin that slight variations means they had a really cash rich year and a tighter year the next. But that aside, the reason why people are buying it at a PE of 57 is because there's growth here. So the future earnings of the company, they think Costco is basically going to keep self-compounding, right? Just make money, reinvest that money into more warehouse stores, more places of the earth, right? They're expanding into China even. So, and nothing seems to stop them. So there is a growing future value here, and that's why people are going to pay for it. And why some people...
Can you scroll up just 1 second? What?
Yeah.
So Costco is expanded into China. Yeah, I heard about that actually.
Yeah. So it's my point is it's compounding, right? It's a
Right.
cash compounder in its operations in a way that DXC is not. If I just go back.
Wait,
to
so a Costco cost $1,000 a share?
Yep.
Interesting.
I thought it was overpriced like 2 years ago, and here it is at 1,000. So you know, sometimes things like that happen.
You know what's so fascinating about Costco? I go to Costco occasionally, and they don't. I mean, they do manufacture allegedly a couple things here and there, you know, or at least they just brand things under Costco or Kirkland or whatever. But they're basically just like, I wonder if they actually make money through land deals or something like that, because they don't actually produce anything other than a centralized location to buy stuff at a very marginal discount.
Costco's money,
yeah.
Costco's money comes from its membership fees, and its and then of course the gross profits on its inventory sales. So the membership fee is basically free money, and then the inventory is basically it's the price minus whatever the cost of goods sold is, and both of those are making them more money than it costs them. So they make some capital investments in new stores each year, and but otherwise they're pretty much always making money on their stores where they go. And like you said, it's a very centralized area, so they can have pretty good operating costs at a single store. And, you go to a Costco, they're not fancy buildings, right? They're not spending a lot of money to make them beautiful stores.
No, it's not. It's very drab and depressing, to be honest with you.
Yeah, but people seem to be happy when they are there. The shoppers and the employees.
Oh yeah, definitely.
Now you go to some retail locations in Manhattan, right? They spend a lot of money just to look nice, right?
Yeah.
And
and you're going to pay for that premium, for sure.
Yeah. But I would also think that maybe some of those locations have problems. So yeah. Anyway, I want to wrap this up. I could maybe look more into what DXC does, and I don't think I would find out. I could probably spend 2 to 3 times as much time as I've spent looking at what they do, and maybe learn 10 or 15% more in detail.
No, I think this is good. I mean, I would just say that, like, I wish this was a better find for you, but at least it was interesting. I expected that this is a total
Well, what's
winner.
nice is like you can still learn something, right? You learn something even from the losers, and in fact, the losers are the ones that are most, because the biggest thing in investing is risk management. So it's very easy to want to research a winner, but if you do research a loser, you can be like, well, this is an example of how a business fails and how a stock, goes like this. I mean, this is just think if you're like, oh, this company is the future, I'm buying here, right? It's just how disappointing all this is. Even if you got in, even in the this is COVID stimulus, this is meme stocking, this is retail investor getting in, even after pumping it up this much, right? You haven't recovered if you got in here. And obviously some people got in here because why else would there be a price quote here? This means trades happened here for many days, right? Like it was basically around the $100 mark from like February to May. So a lot of people bought at 100. So yeah. So I think I know what I will write now. I did have this page up in case I wanted to get notes down, but I don't think I do, or at least not as I was going. But I will probably write something that explains that. I don't write sells anymore because with a sell, the standards are you basically have to write it to justify taking the short position. That's
Right.
the editorial standards. And to me, I would think sell just means take your money and run, right?
Right.
But that's not the editorial standards. So I don't
Got it.
advocate trading on margin. And that's why that is not, I will never write a sell again. It was not immediately as clear when I first started writing for Seeking Alpha. That's what they wanted. But yeah, that's why my sells stopped. We want to look here. We have to go back pretty far. Because you see, I got a lot of holds here. Holds are basically, I'm saying, don't buy it. And that, because hold basically, that's really what hold means. Yeah, okay, so the last sell I wrote was saying why I'm avoiding the Reddit IPO. I was not confident about Reddit when they went public. And that was in March. So I have not written any more since then that are sells. But I probably will write a hold, and I'll basically say, here's why it's not a buy. Here's the bad news. If there is a potential good case, it'll be the one I told you, that through financial engineering, the shares could be bought back at a higher rate of return than the company is shrinking. And of course, that all blows up if they suddenly start shrinking faster. And if we know that there's disruption around the corner, that would be the downside there. So yeah, I don't know how long this business can last.
Right. Not much longer, seemingly.
Yeah, and disruption with about $3.5 billion, which it looks like they're barely in a position to pay off on time as they currently exist, right?
Right.
That's the concern. So yeah, that's probably what my thesis will be. I'll probably write it tonight, and then usually in Seeking Alpha they'll have it up in a day. So we are allowed to give gift links. So what I can do is gift you a link, Jack, and you can read the finished product. If I were to get it out today, it would probably be ready tomorrow evening sometime. So yeah, that's what I'm thinking.
Yeah, absolutely. Yeah.
But yeah, I do appreciate you giving me something to sort of walk you through.
No, I appreciate it. Yeah, and it actually helps me so I can do a little bit more pre-gaming as well, so I can kind of.
So somebody named Pill Eater tried to join the panel. I didn't know if there was a link available.
Oh no, yeah, he has to join, and I trust him. But he's interested in this kind of stuff as well. So.
Okay, I don't think I heard him ping or notification when he opted in. So.
Okay, cool. Yeah, he didn't message me that he jumped in, so it must have been pretty recently.
Okay, yeah. So that's sort of like what a research session might look like for me. I managed to reach a conclusion pretty quickly on this one, I feel like. And sometimes it might be like I might look at it for 3 or 4 hours before I really know, okay, this is clearly if it's buy or hold or something. But I just wanted to see, Jack, there's a lot that I covered here, right? Because I'm just sort of, I'm already spotting things and basically saying, like, as soon as we got in, right? Oh, this, I see this, it probably means this to me. I see this, it probably means this to me. A lot of stuff I went through. I want to know, what are like the really hanging questions you have at the end of this?
For the questions that I personally have right now, I would say I don't have a lot of questions per se, but I definitely see that, you know, there's a lot that goes into it as far as,
Mhm.
you know, basically what the people say, what they say about themselves, and
Mhm.
then what it looks like when you actually start digging in, and that it's actually like kind of what you said there really stood out to me, which is that it's not always what they say, it's what they don't say, right? And I think that
Right.
that actually really has been a big thing for me as far as like research that I've done completely unrelated to this. So that really stands out to me a lot, and I think that it gives me a lot to kind of like
Mhm.
think
Is
about when I look at other businesses, what I've already started looking into. So
Yeah, what's absent, and there are lots of things that even I don't notice because again, I don't know all the things that should be said or done. But I would just say it's an interesting conundrum in life in general, to fail to notice the things that aren't said or done. And like I know a thing for me, for example, is um, there are a lot of things that I avoid saying or avoid doing that I think if, let's say, people knew that I avoided those things, they would be very appreciative. I'm like, oh, you have all these opportunities to do this thing that would make my life harder or at least more annoying, and you don't do it though, Joe. And clearly other people don't exercise that level of restraint, right? But you can't get credit for the things that you um, silently think in your head and say, no, I'm not going to do that. And at the same time, can't really get blamed for those either, right? But if you have sort of an idea of what a standard is, like what would you normally see in a slideshow, um, you know, how would a company normally represent themselves? Um, you know, you can, and you look at enough companies, you can see which companies stand out in that way, and if it's in a good or a bad way. Um, and so, yeah, the lack of really much of a description on the vision or the strategy in their slideshow, um, pretty unusual. Even companies that are almost just portfolio management have a lot more to say about what they're doing in a slideshow.
right, right,
Um,
exactly, yeah.
and um, again, when
So,
you,
so they're definitely in a moment of triage. You would say that they're trying to hold it together. They can't really think about growth
yeah,
at this point in time, to say the least, right? So
right, yeah, and so basically, if you're getting a price to free cash flow multiple of about 5 right now, that's pretty good, even if you ignore the debt for a moment, because basically the market cap is how much debt there is.
right,
Um, uh, if things
The-
suddenly turn around, if suddenly this lid gets blown off, this could easily become like a $50 stock, a $60 stock. If you think about if they could
right,
really unlock value, right? So, and the unlocking value would probably translate to revenue increases with overhead reduction because they
right,
just get AI to do a lot more for
right.
them. Um,
And so they desperately need to find
yeah,
something like that. They
yes.
desperately need to find something
And
like
I would
that.
just say there are thousands of publicly traded companies, and a lot of them don't have these problems, and a lot of them have growth, and not all that growth is priced in. So instead of saying betting
Right,
on the, hey, what if they just magically find a solution that they don't even seem to know what it will be yet? Why not just invest in what's already working? Because if this company goes, if this stock goes to zero, which it can, you know, it's um, if you lose that money, right, it's gone. You don't get to make it back, right? And so even if it makes a lot more sense to invest in the company that maybe it's only 50% upside. Maybe
Right.
put in $1, you'll get $1.50. That makes a lot more sense than going to zero to me. And a lot of people buy stocks are like, oh, it'll go to, if I put in $1, it'll go to 10, right? $10
Right.
for every dollar I put in, right? Like, and then I'll be rich and I can retire. And that's what drives a lot of this, right? This COVID stimulus happens, people do this, like, oh, I can become rich and then I don't have to work anymore, and then I can do everything remotely. And I mean that's not what happens here. So yeah, I'd say hold is probably the best rating to give this. And it might actually be justified just by the fact that it is cash flow positive and the multiple is low. But I'm not seeing a huge upside opportunity where I would feel like I have a very favorable risk reward asymmetry.
Right.
Like when I can show you Root real quick. Not this one, but the one I wrote in August. Oh, wait, no, that's the wrong one. I've covered it 3 times. Did I? Oh, this is okay. Oh yeah, I'm gonna need to cover them again. All right. All right. So if we look here, I looked at what Root basically. It finally had a profitable quarter. They're newer. They were building up their business. They had their first profitable quarter. It was Q3 of last year. So I basically said, here's one quarter. If you do that, if you annualize that, this is basically what 1 year's earnings is now.
Right.
And since they're an insurance company, they would need to be growing their balance sheet, because usually what insurance companies do is they will build up their balance sheet so they have a reserve in the event of a year of a lot of claims. So if we assume no earnings growth, here's what the book value per share. This is basically the value of the balance sheet divided by the number of shares. Right. So current book value plus 10 years earnings per share, it should be worth about this in a decade. If earnings per share grows 10% a year, like a compound growth rate, it should be worth this in 10 years. If it grows 20%, and again, this is a fast growing company, so this is possible, this should be worth this in 10 years, right? So you see there's a spectrum of valuation possibilities. I gave a low end one, no growth. It just keeps up what it's accomplished to the point where it reached profitability, right? So this is a value I got. This is when I published it. It went down a few bucks shortly after I published this, and I basically bought shares of this at 68. Why? Because basically $68 is the no growth story. And I realized there was all this opportunity here, right? So I had a favorable risk reward asymmetry here, right? Worst case scenario, it's going to be worth the same amount of money in the long run. Best case scenario, it'll go up in value. And maybe the market will agree and pull it up to that price before it even really achieves that, right? It shot up to 140 recently. So this is back in November that I wrote this and bought my position. It started to fall down again. I sold it around 135. So it wasn't the uppermost potential, but basically to continue to hold as it got closer to 180. Right, the risk reward asymmetry was not as favorable then, right? So I went ahead and got out and took my profits. I almost doubled, basically, right? 68, 135. It's nearly doubled in about 3 months' time.
And I remember, so you sold at 120, right?
135.
130. And what is it at now today?
Oh,
I missed it. Sorry.
It is here.
Oh shit! You did the right thing.
Well, I mean, that's not really what's going to matter here in the long run. The point is, I secured what the value should have been for the more optimistic end of its future value. I would have just locked it in. And so just as easily 2 weeks from now be back to where I sold it, right? So it feels smart today, but like, how hard would it be for it to just zag back up, right?
Well, if it gets back down to 68, would you buy back in depending
Oh, yeah.
on?
Oh yeah,
Okay, got it.
if it did, I'm considering buying back in again because it's closer the risk reward asymmetry. But you see what I'm saying now? Like
Yeah.
when I'm looking at valuation, I'm looking at it as a business, and I'm looking at a risk reward
Could-
asymmetry.
Because I remember what you said. You said 70 is like what it's actually worth. So there's a little bit of hype going on. Everybody's trying to get money in, obviously, but
Mhm.
but
Yeah,
what you're
but-
saying is, but what you're saying is when it doubled, you know that that double is not really
Right. And part of the
real,
value
yeah.
here is there's a growth story to root. And basically like I can't look at the XC and see something in the value proposal that there's a risk reward asymmetry, because I can value it, yes, but there's no growth for value, right? So that part of anything that it would contribute to value is gone, right? The idea that suddenly there will be growth means it's going to have to stumble onto a magic solution that saves it from its current trajectory, and that's just dumb luck, right? There's nothing to lead me to do that. Now, we could maybe look at its balance sheet, and that's maybe the other thing we could consider here. And its book value per share is 1652. So it's trading slightly above liquidation value. So you could argue that if it like fell to like $9, you get like about a 40% discount on the
Right.
balance sheet to liquidate it. And then we would just want to look like what is actually on this balance sheet. And look, there's a lot of intangible assets here.
right.
So these are probably this is probably their IP, any patents they have. Goodwill Goodwill is basically the premium they paid for their previous M&A. So when they divested that one big business, right, look at how much the divestiture reduced their goodwill. But goodwill is not really anything. You just report it as an asset because it's what you paid.
Right.
So if this company liquidates, there's no reason to think that shareholders would get this. So make this, take about $3 billion off. You have about 12.8 billion in assets against 12 billion. So it's really more of an $800 million company on liquidation rather than a 3.
Right.
So, not a favorable.
I know.
Yeah. So,
Thank you. Thank you. Yep.
so, and the thing is, you would need this to become like a penny stock. If it goes down to $1, then at least in liquidation,
That's okay.
Or
I'm almost
asymmetry.
done.
So it's just because there's no growth here, right? So not really much at this price. It would have to go down a lot in price for whatever cash it's going to run for before it finally sputters out, or if it liquidates, it would need to be significantly lower. There's just it's not like it's terribly risky, we'll say, but there's certainly not a favorable risk reward asymmetry because the reward has to, it doesn't seem like there's much of a reward basically.
You'd have to be on the inside of the company and know something very
Yeah.
personal, right?
Yeah, basically. So that's the thing there, right? So I could look at Root and I could basically say, here's the risk reward asymmetry. It's not like a small rising insurance company is impervious to risk, right? But at the same time, it's one where they are utilizing tech well. They're using technology as a part of the distribution network, and that's why they've had so much growth to the point that their revenues exceed their operating expenses and they're profitable now. So that's basically what it comes down to. Anyway, is that basically it for everything you wanted to know as DXE goes? You feel like you have a good handle on, at the very least, why this is not a business in which you'd want to be invested?
Yeah. Oh, yeah. Definitely. Yeah. I think it definitely gives me an idea, and I think I think it's one of those things where like the only thing that I would be curious to know is like who's their competitors and what edges do they get over these guys. That's definitely something that
They're probably like more competitors than they can count, because we're talking about IT, and it's just like so many people offer IT services, right? And I even
Right.
mentioned, like, a lot of companies have their own IT internally, right? They have an IT guy or an IT department. So your own customer is your competition sometimes, and that's a brutal business.
Right.
Yeah. So
Yeah. And I think that that's kind of the thing is like as the markets are getting, like you said, all the big guys are going to want to do most of that internally for
yeah, big
security
tech,
and IP
and
reasons.
then
Or so.
yeah, and then if any of the non-tech companies want to outsource it, is there anything about this company that suggests that they're going to be picked? Well, if they were being picked, why are they shrinking? Why were they shrinking before AI happened, and why
Right.
were they shrinking
Well,
after?
yeah, and unless they have a edge in the, human capital or technology thing, which it doesn't seem that they do. I mean, they seem to say something about India, but I mean, that seems, a
Oh, and I'll
no-brainer.
say
Of course,
this.
they're going to be in India.
Let's look at their cost of revenues, right? Normally, if they seem to have a good competitive product, their gross margin, their cost of revenue would be a lot bigger. So
Right.
let's look at the profitability here, right? Gross profit. This isn't a bad gross profit, but is it showing that they're a leader? No, because gross profit is basically here's what it costs to have your inventory, your merchandise, your whatever it is.
Right.
It's more of an abstract thing here because a lot of this is services, but this is not a strong starting gross profit, right?
Right.
And this is like because after you factor in like other things and you get down to net income, right? They're technically not even reporting a profit. Their free cash flow is positive, but this is in the single digits at best. And this, so if you want someone just has leading product and you can see it in their margin, look at this gross margin, right? For NVIDIA. And then,
What's that thing that says C plus down there? What does that recommend? What does that represent?
CapEx over sales. So it's I guess it's CapEx as a percentage of sales. Some people care about that.
And what is CapEx?
Additions to property, plant, and equipment.
Okay.
Yeah, and it's basically an expense that's not reported as an operating expense on the income statement. And the rule of thumb for that is, if it's an expense for something that is isolated within that calendar year, it's an operating expense. If it's an expense for something that will be important beyond that calendar year, so more than 12 months, it's a capital expense. Basically, the way you can later count it as an operating expense through depreciation.
Okay.
So, so you build a factory, right? And that's a capital expense to do that. The factory is, I don't think you would build a whole factory if it was only going to be useful for 1 year, right? It's probably going to be useful for many years, and then you will depreciate that capital expense over multiple years in the income statement in following years.
So here's a weird question, if you don't mind me asking. So why is it that NVIDIA, which seemingly is so much more important and profitable of a company than Costco at 126 and Costco's at 1,000?
Oh, I mean, that's just individual shares. I mean, it doesn't mean anything. This is a $3.2 trillion company, right? This is the actual value of NVIDIA as a company.
Right.
And here's Costco's market cap. They're 460 billion. So the market seems to think NVIDIA is actually more valuable than Costco. It's just how many individual shares do they have?
Well, I guess what determines how many shares there are?
It's one, how many shares they say there will be when they incorporate the business, so when they make it public, and then if they buy back shares or if they declare stock splits, or if both occur, it becomes the number moves a lot. So don't focus on the individual share price too much.
Okay, got it.
Usually only with let's go here. Big 5. There we go. Usually only if it's like a penny stock is the individual share price indicative of something.
Wow, the market cap for Big 5 is only 31. Interesting.
Yeah.
I did not realize
basically,
that.
yeah, basically, someone could just come up, like sort of like a more ordinary rich person, right? Not the billionaire class. Could just be like, hey, I'll buy it out. Although a billionaire could buy this out right now, and just for
No
fun.
problem. Yeah, no problem.
Donald Trump could buy it if he wanted. It would be easy.
Yeah. I'm surprised, Musk didn't just come in and buy it as a meme coin or something,
You never know. I mean, he could do it.
Hire us, Musk. We're going to help you grow the sporting goods industry, Come on.
He's like, and you can imagine him saying, well, I foresee that there will be a very important sporting goods market on Mars. People are going to go outside.
We're going to go skiing on the hills of where the face was over on yes, the face. Remember the face on Mars, whatever. We put a ski resort over there.
We're actually having our engineers look at developing a ski slope on Olympus Mountains. It's going to be very well developed.
That's a good impression, actually. That's pretty impressive.
Thank you. Yeah, hopefully the fans like it.
Get the face changer there. Yeah, it's pretty good.
Oh yeah, do that deep fake stuff. Yeah.
Yeah. No, that's
Right.
funny. Like Musk is one of these guys. Not many people can do a good impression of him. That's pretty good.
Thank you.
But yeah, I know you probably want to wrap up, but this is extremely interesting because it's stuff that
Yeah, and I predict as we do more and more companies, you'll be able to spot some of the things in real time that I spot. And
yeah, I definitely have a big list of different sectors that I'm looking at, but I think the tech is like there's a lot of weird tech companies that I think many people don't talk about. I wanted to look at Palmer Luckey's. I can't remember. I don't know how to say that company, but I wanted to look at that one and some others. But
yeah, but one last thing I'll say, just no point that I look at like the last 5 days and like, oh, look at how the stock is trending. I did not worry about that one bit, and that's never how I look at these things.
right,
I look at market responses to things to see what were they responding to, but I am not looking at trends in the charts.
right.
I'm using this as just a measure of how public opinion changed over time. That's it. And public opinion changes over
Okay.
time based on this.
So right. So charts reflect confidence, essentially. I mean that chart.
There's a saying that Ben Graham, the teacher of Warren Buffett, coined, which is the market acts like a voting machine in the short term. We might say this is short. Short could be 1 to 2 years, 2 years tops generally. And it acts like a weighing machine in the long term, right? So in the voting machine, it's almost like a prediction market, right? Ooh,
Right.
this is going to happen, right? And it takes on a life of its own. And a weighing machine in that eventually, if there's a value price difference, positive or negative, right? The market will say it just doesn't make sense for a company to be priced like this. So the reason why, let's just look at what's the QSI? No, QSR. There we go. So this is the holding company that has Burger King and a few other restaurant chains, right? It's a bit of a zigzag, but for the most part, if you look in the past decade, they are higher than they were. I think this is mostly just the effects of inflation, how it affects fast food, and businesses having to shift more to value menus as customers have gotten tighter. That a lot of them have been dealing with that, but for the most part, it's higher in the past decade. Why isn't it still here? Well, if it stayed here, McDonald's would say we can get this big restaurant chain for cheap. Because let's look at the fundamentals, right? Revenues have doubled, right? Looks like gross profits been doing okay. I'm not going to do a whole analysis, but the point is it earns more. And so basically McDonald's will be like, we'll just buy out our competition, right? They could say that. And so the fact that someone could always just say that and be like, this is too cheap, I'm going to buy it up, is what pulls it up over time. And then, of course, in the short term, people just sort of, this can be momentum trading. This can be people like oh, I can get it at a 10% return, long-term return here, gets bought up, and someone will say, well, it's up, but I'll still get like an 8% long-term return. So I'll go ahead and keep buying it, right? It's just, so you can just, lots of things can be implied by short-term movements, whether it's complete change in opinion on the long-term profitability of the company or just what kind of return the buyers in that moment in time find acceptable, right? So the point is, don't overthink the short-term stuff too much. Don't get caught up in like all this. Think about, what does this tell you about why opinions changed? And did it follow the fundamentals or not? And, what can we figure out about the fundamentals going forward? Anyway, that's
Right.
all I got. That's all.
No, that's very useful, and I appreciate it. And I definitely got some curveballs that I'll throw. If you thought this one was, I got some other weird ones that definitely I think will be very fascinating to look at. And I'm also curious, just like kind of what's on your radar, because I'm sure you have a lot of. You and I talked about some really interesting stuff that you're looking into, that's tech related too. And so I'm definitely very interested to kind of learn like how you research those companies, because there's definitely a lot of action, like, of course we know now Ukraine's open for mineral rights. I'm kind of curious, like, what is that going to mean? I'm sure there's going to be a lot of weird things that are, going to be involved in that for sure. As far as, technology, I think there's like gallium there or something. So I don't know. I'm just kind of curious.
Yeah, I'll have to pick my buddy's brain about that. I have a friend, I actually meet him here sometimes, who's a chemist, but he also is into stocks, and he talks a lot about rare earth stuff, because that's his forte.
Right. And I've seen that definitely. I didn't think about it much, but I've seen that a lot of people who look into that, they seem to be pretty good at predicting like some strange things that you wouldn't expect. So I'm definitely kind of curious to look at stuff like that. So.
Okay. Yeah. Well, anyway, I want to go ahead and close up for today, Jack. But it's been a good stream. I'm glad you did it with me, and let me know when you want to do the next episode. Okay.
Yeah, will do. Thank you so much, Joe. Have a great day.
You too.
Bye.